Hi everyone and welcome to PhillipCapital's Market Watch. I am Priyanka Sachdeva from Phillip Nova and today we'll be talking about one of the most watched assets in global markets currently, gold. Over the past year, gold prices have surged to record high, outperforming equities, bonds and even cryptocurrencies. So what's really driving this rally, and more importantly, is the current surge just a cyclic spike or a structural shift? Let's dive straight in. Markets and investors have been amazed by the record high headlines gold has been making throughout 2025. Gold hit 48 all-time highs in 2025 as prices surged and demand stayed strong. It has outperformed global equities and US Treasuries. Volatility in interest rates and persistent geopolitical risk have pushed gold back into the spotlight. Gold is no longer just a hedge, it has earned its place as a core macro asset. The rally we are witnessing in gold is clearly a structural shift backed by four major drivers: central bank buying, expectations of easing real yields as monetary policy pivots, persistent geopolitical flare-ups, and impressive inflows in gold-backed ETFs. Let's look at these structural drivers one by one. Global central banks have been net buyers of gold for 3 consecutive years, with emerging market central banks actively diversifying away from US dollar assets. For the first time in 5 decades, foreign central banks hold more gold reserves than treasuries. In fact, central bank gold purchases are running well above the 10-year average, creating a powerful price floor for the market. After 2 quarters of moderation, central bank buying reaccelerated in third quarter of 2025 to 220 tons of net purchases. In a nutshell, central banks are no longer trading in gold. They are strategically accumulating it. At the same time, real yields and monetary policy uncertainty continue to support gold prices. Gold typically thrives when real interest rates fall. The combination of sticky inflation and slowing global growth creates a favorable backdrop for gold. Meanwhile, geopolitics and physical risk remains key drivers. Ongoing geopolitical tensions are keeping safe haven demand elevated, while rising sovereign debt levels and widening fiscal deficits are fueling concerns over currency debasement. Finally, the robust inflows in gold-backed ETFs. Global gold ETFs recorded 5 consecutive months of inflows in 2025, lifting year-to-date holdings to a notable $89 billion, equivalent to around 674 tons. This signifies that fiscal demand has remained resilient and gold is being accumulated within investment portfolios quietly. While demand drivers are ample, gold supply growth remains structurally constrained. New discoveries are increasingly rare. Mine grades continue to decline, and even at elevated levels, gold prices have failed to trigger a meaningful supply response. Unlike industrial metals, gold supply does not flood the market when prices rally. A key reason why historically gold prices upcycles tend to be more durable and sustained. That brings us to our forecast of gold in 2026. While we expect the gold price rally will likely moderate, gold trading at $5,500 per ounce seems more likely than the prices declining to $4,000 per ounce. With our in-depth analysis, we conclude a base case scenario with a 50% probability of gold trading between $4,500 to $5,000 per ounce. The base case assumes that the Fed remains on hold after the December FOMC until second half of 2026, alongside the appointment of a new Fed chair. We also expect a softer pace in central bank buying, while gold ETF inflows may revert to 25 to 75% of 2025 net flows. In a bullish case scenario with the 30% probability, gold prices are expected to hit $5,500 per ounce. In this upside scenario, central bank demand stays strong, China's economic growth shows signs of revival, and ETF inflows stay comparable to the robust levels seen in 2025. Another reacceleration in geopolitical flare-ups in the Middle East and potential widening of US fiscal deficits. Under our bear case scenario, with the probability of only 20%, gold could correct to a zone of $4,000 to $4,500 per ounce. This scenario assumes a rebound in the USD and improved appetite in risky assets, especially in the AI and tech sector. We also acknowledge that record high gold prices could weigh on fiscal demand globally. However, we think there is plenty of cash on the sidelines to buy the dip. Steady fiscal and central bank demand will likely limit downside risk. To conclude, gold may pause and consolidate in the near term, but the underlying structural drivers of the rally remains firmly intact. Gold surge is backed by real fundamentals rather than the speculation, which means choppier price action instead of a straight line rally. Pullbacks may offer opportunities to accumulate gradually, with gold best viewed as a portfolio insurance rather than a short-term trade. Diversifying exposure through spot gold, ETFs, or gold-related instruments can help capture this shift, as gold increasingly behaves less like a traditional hedge and more like a standalone macro asset. And that's all for today's episode of PhillipCapital's Market Watch. If you found this useful, remember to like, follow, and subscribe to our social media channels. Let us know in the comments, is gold entering a new long-term super cycle or nearing a pause? Thanks for watching, and we will see you in the next episode.